Hello everyone and welcome back to the sessions on financial reporting. Friends, in this class of financial reporting, we are continuing with the topic financial instruments, and this is the sixth lecture on financial instruments. In this class, we are going to learn accounting for financial instruments. So friends, I have always been telling you one thing, that always focus on the objective, what we are trying to learn and why we are learning that. Once you know the objective, once you know what is the question or what is the problem for which this solution has been derived, you will then only understand the whole thing. If you directly jump into the solution part, you are never going to understand which problem you are solving. I am not talking about problems and solutions from a student's viewpoint in examination. I am talking about real life problems. So whatever be the content of any Ind AS, it is always going to be a solution to an accounting problem. So you need to first understand what is that accounting problem which we are addressing. So when we talk about accounting for financial instruments, let me tell you what all we have already covered from the perspective of an issuing company under Ind AS 32. Let me remind that. Just recall, a company issuing equity shares, a company issuing debentures or bonds. Now equity share issue is recognized as issue of equity instrument. If it is issue of bonds and debentures, it is recognition of a financial liability. If it is a convertible debenture, we account for it as compound financial instruments. So friends, from the perspective of the company issuing the instruments, we have covered this concept under Ind AS 32. So what we are going to learn about this accounting for financial instruments over here, let us come to that point. This is from the perspective of the counterparty. Counterparties are investors who have purchased bonds, debentures, shares of different companies. When these investors trade in the secondary market, how would they account for it? That is the issue that we are addressing over here. Secondly, just imagine I am an investor who is purchasing equity shares of X Limited at the prevailing market price. What entry I would pass? Equity shares in X Limited debit to bank account. That's all. If I purchase government bonds, I will write government bonds debit to bank account. If I am purchasing any financial asset, acquiring any financial asset, I would simply record financial asset debit to bank, because I am purchasing it, acquiring it by giving cash. What I am trying to tell you is, a spot transaction, I don't have to tell you how would you pass journal entry for a spot transaction. So even if it is a spot transaction of selling a financial asset, for example, I am holding some government bonds which I would want to sell. The carrying amount of government bond is 92,000 and I am selling it for 96,000. So what I would do, bank account debit 96,000 to government bonds 92,000, and the gains on sale will be recognized immediately through the statement of P&L. You know even that part of accounting. So friends, we are not addressing any of these issues. That is why I have been telling you past 5 minutes that you should look into what is the issue that we are addressing, what is the problem that we are attempting to solve. We are talking about a situation where an entity or an individual enters into a contract today to buy or sell a financial asset at a later date. That means it is a kind of forward contract that we are trying to learn over here. You are entering into a contract today, you are fixing the price today, but you are going to settle this contract at a later date, something called a derivative. So we have a contract entry date and a date of settlement. These two dates are defined as trade date and settlement date by Ind AS 109. So friends, what you need to first of all do is look into the substance of the arrangement, because substance of an arrangement is the most important thing. It will define how you are going to classify and pass accounting entries for a given series of transactions within a contract. So look into the substance of the arrangement or substance of the contract. So suppose I enter into a contract with you that I will purchase from you shares of X Limited at a defined price today. So price is defined today, but I am going to purchase these shares from you after 3 months. So what will happen? After 3 months, the price of the share will definitely fluctuate in the market, and I will make a gain or loss. You being a counterparty, you will also make some gain or loss. My gain will be matching with your losses and so on. So the point is, look into the substance of the contract. Are we actually going to buy and sell this asset? If the answer is yes, we define it as a regular way of purchase or sale. I repeat, a regular way of purchase or sale, where I am actually going to purchase from you a financial asset and I will settle that payment by delivering cash or some other financial asset, whatever has been agreed. So friends, if the substance of the arrangement is little different, suppose we have entered into a contract to buy and sell, but that contract happens to be a speculative forward contract, and a speculative forward contract will be settled on a net basis, and one party making losses will pay to the counterparty who has made gain. So the settlement will be in cash, and that amount of settlement will match with the price differentials multiplied by the total quantity contracted for. So my point is, if it is a speculative contract, a non-deliverable contract, then it is not a regular way of purchase or sale. If it is not a regular way of purchase or sale, then between the trade date and settlement date, the instrument will be accounted for as a derivative. If the instrument is accounted for as a derivative, it is a derivative type of accounting that you will follow up for such financial asset acquisition or sale, whatever it is. Because you are actually not going to purchase or sale, it will be derivative accounting that will apply. If you have intention and objective of actually buying or selling a financial asset, then it is termed as a regular way of purchase or sale. Now, Ind AS 109 also clarifies that a regular way of purchase or sale can be accounted for either applying a trade date accounting or applying a settlement date accounting. So a trade date accounting or a settlement date accounting, either of these two accounting approaches can be applied. So that is completely left as a choice to the entity. Entity can choose to adopt anything. However, if as a student you would ask my advice on this, I would strongly recommend adoption of trade date accounting. Here my responsibility is to convey both the approaches of accounting to you. For the purpose of learning, we have to prepare it, and in examination anything can be asked, but you in real life you should always prefer application of trade date accounting. If you are not having any idea about what is this trade date accounting and what is this settlement date accounting, don't worry about it. We are going to learn everything in details at length, and we are going to take lots of calculative examples, small examples to understand the whole matter. So let us do one thing. Let us first write a note about this regular way of purchase or sale and application of trade date accounting or settlement date accounting. And we also write a note about derivative accounting. So let us first write notes and then we begin with questions. So friends, whatever we have just discussed about regular way of purchase or sale, we would say a regular way of purchase or sale of financial assets is recognized using either trade date accounting or settlement date accounting. Now, we will be learning both of these accountings in details ahead, but one thing that we should write further over here is a contract that requires or permits net settlement of the changes in the value of the contract is not a regular way contract. Instead, such a contract is accounted for as a derivative in the period between the trade date and the settlement date, and what we can say, that is application of derivative accounting. Now friends, what is trade date, what is settlement date, I have explained to you. We are going to write notes about that also little later, but first what you should do is write whatever you find on the screen quickly. Alright friends, you would have finished writing these notes. Now in the sequence of learning this whole thing, we will be first focusing on this derivative accounting part, and that we will take through an example which is covered under question number 24. Let us read this question. On 23/11/2019, A and B entered into a speculative contract where A agrees to buy 4,000 equity shares in X Limited on 30/6/2020 at rupees 160 per share, irrespective of actual market price prevailing on that date. As none of the parties actually intended to make any purchase or sale, they agreed to settle the net differential in cash. The actual market price of equity shares in X Limited were on 31/3/2020 rupees 154 per share, on 30/6/2020 rupees 170 per share. Explain the accounting treatment in the books of both the parties. So friends, let us first discuss this entire scenario. So assume that I am A and you are B. We have made a contract at today's date. Today's date in this example is 23rd November 2019. where A has agreed to make a purchase from B, what? 4,000 equity shares of X Limited at an agreed price of rupees 160 per share, and this settlement will take place on 30th June 2020. So let us analyze the given facts. Fact number 1, this is a case of a forward contract. Why? Because two parties A and B, we have agreed to make a purchase or sale of a defined asset at a defined future date at a price which is agreed today. It is fulfilling the condition of a forward contract. Now, there are two different dates given. One is today's date, that is the contract date, 23rd November 2019. Ind AS 109 identifies this contract date as trade date, and the final date of settlement will be just known as settlement date. So 23rd November 2019 in our example is trade date, and 30th June 2020 will be settlement date. Now, the other fact given in the question, that none of the parties actually want to purchase and sell. That means the parties are just interested in speculation. They have used this forward contract only and only with a speculative intent. As a result, this will not attract the regular way of purchase or sale. So, between the trade date, that is 23rd November 2019, to settlement date, that is 30th June 2020, as per requirements of Ind AS 109, during this period, the contract will be accounted for as a derivative. In simple words, derivative accounting shall be applied. You cannot apply trade date accounting and settlement date accounting, because those accountings are applicable for regular way of purchase or sale. So, after all this discussion, let us now come to accounting entries that will be applied over here when it is derivative accounting coming into picture. So, we begin with the date of contract, that is a trade date. So, now there is one information which we find missing in the question. Question does not inform what is the market price of these equity shares at the date of contract. In absence of information, we are going to assume that the market price of equity shares of X Limited on 23rd November 2019, that was also rupees 160. Because if that market price is anything other than 160, there will be some gain or loss arising for either parties. So, in absence of information, we are considering the price to be at same level, that is 160. That is a spot market price on 23rd November 2019 is rupees 160 per share. As a result, as on the date of contract, that is 23rd November 2019, none of the parties have actually made any gain or loss. This is a fact. None of the parties have made any gain or loss. As a result, no one would recognize anything. So, there will be no financial asset or financial liability recognized. And mind it, this is not a regular way of purchase or sale. We are not implementing trade date accounting or settlement date accounting. So, just keep those things out of the picture. Here, this will be accounted for as a derivative, and a derivative asset or a derivative liability will emerge only and only when such contract becomes potentially favorable to one party and potentially unfavorable to the other. In this case, at the date of contract, that is on 23rd November 2019, there is no favorable or unfavorable condition arising for either party. None of the parties will pass any accounting entry. So, no accounting entry shall be passed by A, no accounting entry shall be passed by B. Now, let us move to the other date. Now, between trade date and settlement date, do you find there is a reporting date, that is 31st March 2020. So, on 31st March 2020, the market price of this share has fallen down to rupees 154 per share. Now, what happens? I am A, you are B. I have agreed to buy at what price? 160. That means I have agreed to purchase something at 160 whose prevailing market price at the reporting date is just 154. If the price is 154 and I have agreed to buy at 160, don't you think it is a loss to me? It is indeed a loss to me. The contract has become potentially unfavorable for me. So, as on the reporting date, that is 31st March 2020, I will record a loss against a derivative liability. Now, if I am recognizing a derivative liability at the reporting date, that is 31st March 2020, what would happen? I will record a derivative liability only when it fulfills the condition of financial liability, because a derivative liability by its basic nature is or has to be a financial liability. That means whatever liability I am recognizing, it must be defined under financial liability, or it must be covered under the definition of financial liability. And we have learnt these definitions right on the first lecture, if you can recall. One of the components of financial liability definition, what was that? It was a derivative liability. In other words, a contractual obligation that arises because two parties have entered into a contract to exchange financial asset. In yet other words, I would say a contractual obligation to exchange financial assets with another entity under conditions that have become potentially unfavorable to the entity. So, it is exactly that same case. For me, this scenario has turned to be potentially unfavorable for me as at 31st March 2020. So, how much is the loss with which I am suffering on that date? Do you know? Per share, the price has fallen from 160 to 154. Per share, it is a loss of rupees 6. 4,000 shares multiplied, it is a total loss of 24,000. Suppose the same scenario continues by 30th June and settlement date arises, I will have to pay to you 24,000 rupees. That means my liability as at 31st March 2020 is already 24,000, and therefore against this liability I will record a loss. So, the journal entry that I would pass will simply be P&L debit to a derivative liability 24,000. For you, the same is a gain. Now, recollect the component of definition of financial assets. One of the component of definition of financial asset was what? A financial asset is a contractual right to exchange financial assets with another entity under conditions that are potentially favorable to the entity. So, for you, it has become a favorable condition, what became unfavorable for me. Now, you have a right to sell a share at rupees 160 whose market price is just 154. So, market price is 154, you have a right to sell it at 160, you have made a gain of rupees 6 per share. In total, you have made a gain of rupees 24,000. You would record a derivative asset of 24,000. So, journal entry in your books will be derivative asset debit to P&L. Now, that was the scenario on 31st March 2020, but the settlement date is yet to arrive. When we arrive at the settlement date, look at the information. The market price of that share increases and it goes to what? 170. Boss, now I have made a gain and you have incurred a loss. Do you know how much gain I have made? From the previous recognition on 31st March till the date of settlement, that gap, the share price has increased from 154 to 170. So, it is an increase by rupees 16 per share multiplied to 4,000 shares. It will be a gain for me, that is rupees 64,000. 4,000 multiplied by 16 would give me a total gain of rupees 64,000. So, how would I record this? First of all, 64,000 has to be taken to the credit of my P&L. Now, what will happen? On 31st March, the derivative liability that I have recognized, I will have to square off that liability, and with the balancing difference, I have to create a derivative asset. So journal entry in my books on 30th June will be derivative liability debit 24,000, that is cancellation of the old derivative liability that I have created. Then derivative asset debit 40,000, that differential amount which is arising as a net benefit to me, and to P&L 24,000 plus 40,000, that is 64,000. Now friends, you should understand the calculation of each of these three amounts. First of all, my incremental gain is 64,000 which goes to P&L. My overall gain is 40,000. How my overall gain is 40,000? My overall gain is 40,000 because I have agreed to buy something at 160 and finally on 30th June the price has gone to 170. That means something whose market price is 170, I have agreed to purchase at 160. I have got a benefit of rupees 10 per share multiplied by 4,000 shares. I have a financial asset to be recognized in my books on 30th June amounting to rupees 40,000. So old derivative liability gets squared off, new financial asset in the form of a derivative asset will be recognized, and aggregate of these two both as a benefit will be taken to the credit of P&L, and the amount of gain recognized in total will be rupees 64,000. For you it will be a loss of 64,000. You would write P&L debit 64,000 to derivative asset which you are going to write off your old derivative asset, to derivative asset 24,000 and to derivative liability 40,000. That derivative liability is arising because you will now have to pay that differential to me. Why you have to pay that differential to me? Point is very simple. You have agreed to sell the share at rupees 160 where the prevailing market price is 170. So because the settlement is to take place on a net differential basis, you will pay me that difference of 10 rupees, that is difference between 160 and 170. 10 per share multiplied by 4,000 shares, you would pay to me rupees 40,000. So friends, don't forget, the previous recognized derivative asset and derivative liability in the books of both of us will be squared off, and a financial asset and financial liability in the form of derivative asset and derivative liability will again be recognized on the settlement date, that is 30th June, and finally the settlement would take place when you will pay rupees 40,000 to me. So friends, I have just been talking about the whole process, but this whole explanation will be better understood when the journal entries are there in front of you. You will be able to get all calculations and all accounting traced out. But when I am giving you those journal entries over here, don't rush up writing those entries. Once you understand the concept, then you can solve n number of questions. So whatever we have discussed, this becomes even a platform for learning trade date accounting and settlement date accounting with the follow-up questions ahead. So friends, please try to understand everything and write down each entry one by one. Friends, in your solution, you would first write a note that as per Ind AS 109, the given contract being speculative will be classified as a non-deliverable contract. This is not regular way of purchase or sale. Therefore, both the parties shall apply derivative accounting. Write up this quickly and then we shall proceed ahead. Alright friends, you would have finished writing this note. Let us proceed ahead and now record the entries in the books of A under the head derivative accounting, and we first begin with the trade date, that is on 23rd November 2019. As I have explained you earlier, no entry shall be passed in the books of A because there is no differential gain or loss arising at the trade date, that is at the date when the contract was entered into. It was neither potentially favorable nor potentially unfavorable for A, and therefore no entry shall be passed. Let us now arrive at the next date, that is 31st March 2020, the reporting date. So at this reporting date, A has incurred a loss of rupees 24,000. Why A has incurred a loss of rupees 24,000? Let me explain this once again. You notice one thing, that on 31st March 2020, the market price of shares of X Limited is reported as rupees 154. This party A has agreed to purchase these shares at 160 and the prevailing market price is just 154. As a result, the difference between 154 and 160 is the loss arising for A, and what A will have to do is record that loss of rupees 6 per share multiplied to 4,000 shares. The total loss to be recognized on 31st March 2020 will be rupees 24,000. So entry passed will be profit and loss account debit 24,000 to derivative liability. Now why a derivative liability? I have explained you. Basically, one of the component of financial liability definition is a financial liability is a contractual obligation to exchange financial assets with another entity under conditions that are potentially unfavorable to the entity. So because of those unfavorable conditions, 24,000 has arisen as a liability for A and an asset for B. So when we go to the books of B, we are going to recognize a derivative asset against a gain of the same amount, that is rupees 24,000. Now let us arrive at the settlement date, that is on 30th June 2020. What will happen on this date? First of all, the market price on this date has become rupees 170. So from this date to this date, the increase in market price is by rupees 16, correct? From 154 to 170, it is an increase by rupees 16. As a result, what will happen is the total gain recognized by A will be 16 multiplied by 4,000 shares, that will be 64,000. Now friends, important thing is how to arrive at that incremental gain of 64,000. Never go wrong with that. On the previous reporting date, the market price of the share was 154. You have already recognized gain or loss up to that date. From that date till the date of settlement, the increase in the market price will be a gain for A. So what will happen? I'll give you yet another logic behind this, but first you understand that difference of 154 and 170, that is rupees 16 per share multiplied by 4,000 shares would give you a total gain of 64,000. To recognize that gain, first of all what you will do is you will square off this liability of 24,000 by debiting that liability. You will now recognize a derivative asset of 40,000 and aggregate of these two will be taken to the credit of P&L, that is 64,000. Once again, try to understand one thing. What is the logic behind this derivative asset recognition? If you can see the other ground of logic, we would say A has agreed to buy these shares at 160 and the prevailing market price on the settlement date is 170. So something whose price is 170, A has agreed to buy that just for rupees 160. Can we agree that A has made a benefit of rupees 10 per share? On an overall basis, A has made a benefit of rupees 10 per share. So obviously there will be an overall a derivative asset that will arise. Finally, it is A who is going to collect rupees 40,000 from B. How to get this 40,000? Once again, I am telling you, the agreed price for A to purchase was rupees 160 and the prevailing market price is 170. Difference between these two market prices is the benefit for A, for which A would recognize a derivative asset in the form of a financial asset. But there will be no payable now remaining for A, and therefore A will have to square off this liability. So basically, overall basis, there is a benefit of 40,000 which will be accounted for as a derivative asset, and the previously recognized derivative liability will be offset. Now you can see one thing, you are writing off a liability by 24,000 and creating a new derivative asset by rupees 40,000. So obviously the overall benefit 64,000 will be taken to the credit of P&L. Now in the books of A, derivative liability has been written off. What remains is a derivative asset of net 40,000 which will be recovered in cash from B, that is the counterparty. So on 30th June, that is on the settlement date, A would finally receive rupees 40,000 from B. So the entry passed will be bank account debit to derivative asset, that is rupees 40,000. So friends, please systematically understand everything and write up. Please do not copy these entries. It is required that your fundamental understanding with calculation and accounting entries both should be very clear. I am giving you time, understand everything and write properly. Alright friends, you would have finished writing all these entries. Let us move ahead and write up the books of counterparty, that is B. So obviously wherever A has incurred a loss, B would have made a gain. Where A is recording a derivative liability, B would record a derivative asset. Whenever A is recording a gain, B will have to record a loss of the same amount. And finally, on the net settlement at the end, if A is receiving a lump sum amount of 40,000, it is obvious that B will have to pay that amount of 40,000. So it will be exactly opposite effect of what we have seen in the books of A that will happen in the books of B. So let us see how to write up those entries in the books of B. So first of all, on 23rd November 2019, no entry shall be passed in the books of B. On the first reporting date, that is on 31st March 2020, it will be derivative asset debit to profit and loss, that is 24,000. On 30th June 2020, B will record a loss of rupees 64,000 by reversing the derivative asset of 24,000 and recognizing a new derivative liability of 40,000, which will be paid off immediately. So because A has to receive 40,000, obviously B has to pay that amount of 40,000. So friends, once again I am telling you, don't just copy the entries, understand and write. I am giving you time, note down everything systematically. Alright friends, you would have finished writing these entries. That was the end of that solution. Let us move ahead and write up the next heading, that is trade date accounting. So let us first talk about what is this trade date accounting all about. So first of all, this is one of the two different ways of accounting suggested by Ind AS 109 with respect to a regular way of purchase or sale. So friends, the previous example that we have seen, which was a speculative contract, just imagine if it was not a speculative contract and the two parties A and B wanted to actually exchange the financial assets, that is A would actually buy 4,000 shares in X Limited from B. In that case, it will become a regular way of purchase or sale, and finally you would apply either trade date accounting or settlement date accounting. To understand what is trade date accounting and what is settlement date accounting, you should be very clear with what is the trade date and what is the settlement date. Trade date is the date at which the two parties enter into the contract. In our example, it was 23rd November 2019. What is the settlement date? Settlement date is the date at which the two parties would settle out all their receivables, payables, and they would settle out that particular contract obligation or contractual rights, whatever it results into. In our example, the settlement date was 30th June 2020. So friends, when the two parties do not aim at a speculative contract, but they actually want to make an exchange, they actually want to buy and sell the shares, in that case you will consider that as a regular way of purchase or sale, and within that you may apply either trade date accounting or settlement date accounting. So right now we have a focus point of understanding what is trade date accounting. And now for reference, we take that same example which we have dealt with in question number 24, and as I told you, we will make one change. This time it will not be a speculative contract, it will be a contract where actually both the parties wants to exchange financial assets. So actual purchase and sale will take place. And so how to apply trade date accounting under the head regular way of purchase and sale, let us try to understand that. So first thing, what will happen is, I am A, I will recognize the shares in X Limited right at the trade date, means at the trade date itself, that is on 23rd November 2019, I would pass an accounting entry where I would recognize shares in X Limited. Now because it is an equity instrument of another company where I have made an investment, I will be putting that asset under FVTPL category, correct? Because it is placed under FVTPL category, it will be recognized at its fair value on that date. So at the trade date itself, I will record shares in X Limited debit by its fair value, and the corresponding credit will be given to B, the counterparty B, because that much money I am liable to pay to B. However, the amount payable to B is a fixed amount, correct? It will be 4,000 shares multiplied by rupees 160, that would give us what? Rupees 6,40,000, a fixed amount. However, the amount that you are placing to the debit of that shares in X Limited will represent its fair value. Now what will happen? The recognition of financial asset which I have yet to acquire has been made at the trade date itself, with a corresponding credit given to recognition of a liability due towards the counterparty. Now friends, just imagine by the time the reporting date, that is 31st March 2020 arrives, what will happen? Any change in the fair value, obviously it will affect me. Why? Because I am carrying that asset already in my accounting records at FVTPL. That means if there is any change, the fair value changes will be routed through P&L. So the resulting gain or resulting loss, as the case may be, will be recognized through P&L. However, amount that is due to the counterparty, that is B, it will not change because it is a payable and that will be simply paid off at the settlement date. That amount will not change, it will remain 6,40,000. So what would happen, do you know? With every change in the fair value, the financial asset itself had been recognized right from the trade date. You just have to alter the value of that financial asset. So to summarize what A will do, I would say A will record the financial asset as well as the corresponding liability, both of these at the trade date itself. Then at settlement date, what would actually happen is the payment will be made to B, and just the entry for settling the account of B will be recognized. The asset in the form of shares in X Limited had been recognized right from the trade date. That was from A's perspective. What about B? If B also follows trade date accounting, then B will have to de-recognize the shares in X Limited right from the trade date. So in B's records, shares in X Limited would have been a financial asset which B has agreed to sell to A. At the trade date itself, it will be de-recognized, removed from the books, and the corresponding debit effect will be given by recognizing a receivable in the name of A. So B will pass an entry in its books as A's account debit to shares in X Limited. Any gain or loss arising by transfer of that shares or de-recognition of this shares in X Limited will be immediately transferred to P&L, because it is implied that B would also have carried shares in X Limited under FVTPL category. Now, with every reporting date coming up till the settlement is finally happening, any change in the fair value will not affect B. Why? Because B has already de-recognized that financial asset. So friends, this is what we call as trade date accounting. So under trade date accounting, the recognition and de-recognition of financial assets and the corresponding recognition of liability or asset, as the case may be, happens right at the trade date, and then the fair value changes will affect only one of the party who has taken position, or you can say who has taken long position in that asset. Long position means the position of buying that asset. So once I agree to buy the shares of X Limited at a fixed price of rupees 160 per share, after that point any fluctuation in the value will not affect B, it will affect A. Why it will not affect B? Because B is going to receive a fixed amount, it will not affect B, it will affect A only. That is why trade date accounting, I told you earlier, will support the recognition of gain losses to the right party. That means the party that will be getting affected with the changes in fair value is A in this example, and so it is A's financial records, A's accounting records which gets affected because of the change in the fair value. That is the speciality of trade date accounting. So friends, what we will do is we will continue taking a calculative example which will be extension of that same example with just a condition getting altered, and we will solve that question to get complete idea of trade date accounting from the viewpoint of both the parties, A and B. And before that, we would also write a summary notes of what we have just conceptually discussed. So based on what we have just discussed, the trade date is the date that an entity commits itself to purchase or sell an asset. Trade date accounting refers to recognition of an asset to be received and liability to pay for it on the trade date, and de-recognition of an asset that is sold, recognition of any gain or loss on disposal, and recognition of a receivable from the buyer for payment on the trade date. That means recognition and de-recognition both will happen at the trade date itself. So friends, write up these notes and then we shall move ahead. Alright friends, you would have finished writing these notes. Let us move ahead and now take up question number 25. Let us read this question. Consider the information given in question 24. What will be your answer if A and B decided to actually buy or sell the shares in X Limited and delivery to be made on 30th June 2020? In this regard, assume that the fair value of shares on 23/11/2019 was rupees 160 per share. Consider the application of trade date accounting for both the parties. So friends, we have factually discussed everything in this example. So for us, it is now just a formality to present the solution and understand it completely by writing all the entries and calculations. So let us see how to present the solution. In your solution, you would first write, as per Ind AS 109, the given contract can be classified as a regular way of purchase or sale. As per Ind AS 109, such contract can be accounted for by using any of the following approaches, either trade date accounting or settlement date accounting. This question has emphasized trade date accounting, so we would write, if the parties apply trade date accounting, the accounting shall be carried out as below. So friends, write up this description first and then we will write up those entries. Alright friends, you would have finished writing this whole thing. Let us move ahead and write up accounting entries in the books of both the parties, that is A and B, starting from books of A. So because we are following trade date accounting for both the parties, what you would do is, from the viewpoint of A, you would recognize shares in X Limited right from the trade date, which is 23rd November 2019. So you will recognize shares in X Limited, that will be 4000 shares multiplied by the fair value of rupees 160 per share. So the recognition of this financial asset is made at its fair value of rupees 6,40,000, and same is the amount that is agreed to be paid to B, that is 4,000 shares into rupees 160 per share, that will also come up to 6,40,000, by which A will recognize a liability due towards B. So the entry finally would read out as shares in X Limited debit to B's account 6,40,000. Now what will happen at the reporting date, that is on 31st March 2020, the fair value of the shares has got reduced to rupees 154. So the point is so clear that shares which were originally valued at rupees 160, now by 31st March they have been valued at 154. So simply one of your financial asset has lost its value, and therefore there will be a loss arising at the rate of rupees 6 per share, and that will be recognized through P&L. So 31st March, what you are going to do, simply recognize a loss by writing this entry, profit and loss account debit to shares in X Limited. The moment you pass this entry, out of 6,40,000 of previous amount, you have reduced the amount by 24,000 and recognize the loss immediately in the statement of P&L. Now what would happen on 30th June? On 30th June, the value of these shares has gone up to 170. So from rupees 154 per share to rupees 170 per share, it is an overall increase by rupees 16 per share, which would totally work out to rupees 64,000, and the corresponding effect will be given to P&L by way of recognizing a gain because of fair value changes. And if you can see one more thing, after the initial recognition, it is just this financial asset which is getting changed because of the fair value changes, and the corresponding effect have been passed through P&L. This account, B's account, remains a liability as it is till settlement date, and therefore this is the amount to be settled out. Anyway, it was a fixed amount to be paid to B. So finally on 30th June, you simply pay out that amount to B. So B's account debit 6,40,000 to bank account 6,40,000. So friends, write up all these entries, and then we shall move to the books of the other party, that is books of B. Alright friends, you would have finished writing all these entries in the books of A. Let us move ahead and write up the books of B. So on 23rd November 2019, B will debit A's account and the corresponding credit effect will be given by derecognizing the financial asset which represents shares in X Limited. So basically what B is doing, B is derecognizing shares in X Limited and it is recognizing a receivable of rupees 6,40,000. Now what will happen on the reporting date in between, that is 31st March 2020? B will not pass any entry because B has already derecognized the financial asset in the form of shares in X Limited. So B is not getting affected because of the fair value changes. However, on 30th June 2020, when the settlement date arrives, what B will do is B will simply receive that 6,40,000 from A, and finally all the accounts between A and B gets settled out by this receipt. So friends, the books of this party B is indeed much of a simpler task. So quickly take note of this, and that will be end of the solution. Alright friends, you would have finished writing this whole thing. Let us move ahead and take up next question, that is question number 26. Let us read this question. Consider the information given in question 24. What will be your answer if A and B decided to actually buy or sell the shares in X Limited and delivery to be made on 30th June 2020? In this regard, assume that fair value of shares on 23/11/2019 was 158 per share. Consider the application of trade date accounting for both the parties. Now friends, this is more or like question number 25 with one change. What was the change? In question 25, this price was 160. Agreed price for settlement between A and B is also 160. As a result, on 23rd November 2019, at this date, at the trade date, there were no gain or loss arising for both the parties. However, now when the price over here is different from the contract price, definitely the parties would have any gain or loss to be recognized at the early stage. So let us see how to present the solution. So we would first write up a description that as per Ind AS 109, the given contract can be classified as regular way of purchase or sale. If the parties apply trade date accounting, the accounting shall be carried out as below. We start with books of A. I told you it is as usual thing, just one small difference, and that difference I am going to explain you right now. What you will do is, at the trade date, that is on 23/11/2009, shares in X Limited, this time these will be recorded again at their fair value. Fair value in this example, in this case, it is 158. 4,000 into 158 gives you 6,32,000. On the other side, the contract price for this purchase sale was agreed for 160, correct? So A will write to B's account 6,40,000. This is basically 4,000 shares into 160. Now what will happen? The shares have been recognized as 6,32,000, that is a financial asset, and the financial liability has been recognized at 6,40,000. This is in the nature of a short term payable. This is in the nature of FVTPL. Difference between these two will be recognized as a loss immediately. So P&L debit, it will be 4,000 shares multiplied by 2. 2 is the difference between 158 and 160. So friends, write up this entry and then I show you other entries at the other dates. Alright friends, you would have finished writing this entry. Let us move ahead and go to the next date, that is the reporting date, 31st March 2020. At this date, the share price was rupees 154 and the previously recognized value was 158. So per share there is a further decline by rupees 4. So there will be a loss recorded in the books of A. 4,000 shares into rupees 4 per share, that is 16,000, and the corresponding credit will be given to the shares in X Limited account, that will be the financial asset value getting reduced and the loss recognized. So this is straight entry on 31st March 2020. Now what happens on 30th June 2020, that is at the settlement date, there will be again a change in the price of the share. Now this time the share price has increased to 170. Previous recorded price was 154. So from 154 to 170, the increase is by 16 per share multiplied by 4,000 shares, it will be 64,000, and to P&L again 64,000. So you have recognized again by increasing the value of financial asset at the settlement date. Finally, the shares have already been recognized because of trade date accounting. Now you have to settle B's account by making a cash payment. So last entry would be B's account debit 6,40,000 to bank account 6,40,000. So friends, between question 25 and question 26, these three entries what you find on the screen are same. What was different was the initial entry, because generally students have a doubt, sir, what will happen when the trade date share value is little different from 160. That is why I have specifically covered that example. So friends, take note of this, and that will be end of A's books, and then we will switch to books of the other party, that is B. But first write down what you find on screen. Alright friends, you would have finished writing this whole thing. Let us move to the books of B. In B's books, at the trade date, that is on 23/11/2019, you will derecognize the financial asset which is in the form of shares in X Limited, and you will recognize a new financial asset which is a receivable in the name of A. So A's account debit. Now A's account debit being a receivable, this will be indicated by a contract amount, correct? The contract amount is 6,40,000, and the corresponding credit will be given to shares in X Limited, which is a financial asset in FVTPL category. This will be derecognized. This value is 6,32,000 and this value is 6,40,000. Difference between these two will be obviously a gain recognized by B at the trade date itself. So after recognizing this A's account as a receivable and derecognizing shares in X Limited, B will not be affected by any change in the fair value of the shares at the reporting date and ahead. That is, after this trade date, any change in the fair value of shares in X Limited will not affect this party B. As a result, B shall not pass any entry on 31st March 2020, and as on 30th June 2020, B will simply receive cash of rupees 6,40,000 from A, and that will be end of B's books from trade date to settlement date. So friends, write up these entries and that will be end of the solution. Alright friends, you would have finished writing this whole thing. Let us move ahead and write up the next heading, that will be settlement date accounting. I will explain you the application of settlement date accounting through that same example where we will make some modification. But before we do that, first write up some notes with respect to settlement date accounting. The settlement date is the date that an asset is delivered to or by an entity. Settlement date accounting refers to recognition of asset on the day it is received by the entity and derecognition of an asset and recognition of any gain or loss on disposal on the day it is delivered by the entity. Now friends, write up these notes quickly and then we shall move ahead. Alright friends, I am sure you would have finished writing this whole thing. Let us move ahead and now we take up one more calculative example given under question number 27. It says, consider the information given in question 24. What will be your answer if A and B decide to actually buy or sell the shares in X Limited and delivery to be made on 30th June 2020? In this regard, assume that the fair value of shares on 23/11/2009 was rupees 160 per share. Consider the application of settlement date accounting for both the parties. Friends, now this is just same situation what we have seen in question 25. However, question 25 demanded trade date accounting. This is application of settlement date accounting. So I am going to explain you this through this example itself. So all the facts and figures you know already, and let us just begin with the solution of this. So what you will do is, in books of A, at the trade date you will not record anything. Why? Because the accounting method followed is not trade date accounting but settlement date accounting, and therefore no asset recognition and derecognition will be made at the trade date. However, A has been the party who has in substance being the owner of this equity shares in X Limited. Therefore, any change in the value from this date onward, it will not affect B, it will affect A. Why it will not affect B? You know one thing very well, that B is going to receive a sum of rupees 6,40,000 irrespective of any further fluctuation in the price. So B will never get affected with the price changes, but A will definitely get affected. As a result, what you will do is, the change in price from rupees 160 to rupees 154 between the trade date, that is 23rd November 2019, to the reporting date, that is 31st March 2020, there will be a change in price from 160 to 154. As a result, there is a loss of rupees 6 per share. Multiplied by 4,000 shares, there will be a total loss of rupees 24,000, and this 24,000 loss will be recognized against a corresponding derivative liability, and that goes to derivative liability, that is B's account. Now friends, here there is a problem with the settlement date accounting application. See boss, one thing, this profit and loss debit, that means this recognition of loss of 24,000, this is straight away unavoidable. If you follow trade date accounting, you have an asset in your books to credit, correct? That is the shares in X Limited. Because here there is no asset recognized at the trade date, you have to just create a derivative liability of the equivalent amount. We will offset this liability at a later date, but let us move to the settlement date now. At the settlement date, what happens, that the share price has increased from 154 to 170, thereby a gain of 16 per share arises, and 16 per share multiplied by 4,000 shares, there will be a total gain of rupees 64,000. So what A will do, A will write off that derivative liability of 24,000, instead recognize a derivative asset of 40,000, and the corresponding credit will be given to P&L by recognizing the profit of rupees 64,000. Now friends, this derivative liability has been knocked off, but now a derivative asset has been recognized. What you will do now is, you will offset this derivative asset in the immediate next entry, that is the settlement entry. How you will do that? It is very simple. Equity shares in X Limited debit, that is 6,80,000. How we got 6,80,000? These are investments, or these are financial assets classified under FVTPL category. Because a settlement date accounting is followed, it is at the settlement date that A has recognized these shares in X Limited. At this date, there were 4,000 shares, and each share had a fair value of rupees 170. 4,000 into 170 would give you 6,80,000. However, the settlement will be made by paying only 6,40,000, which was the agreed value. Because there is a difference between these two, there will be something required to be adjusted over here, and that something is nothing but this derivative asset. Therefore, you will write this entry to B's account, that is derivative asset 40,000. Now friends, you can clearly compare and observe. You will yourself find trade date accounting more logical as compared to settlement date accounting. But as far as learning is concerned, you have to learn both the types of accounting. So I am giving you time. Please note down the entries in the books of A, and then we shall move ahead and record the entries in the books of B. Alright friends, you would have finished writing this whole thing. Let us move ahead and see what will happen in the books of B. Now in books of B, the treatment is much straightforward. On 23/11/2019, that is at the trade date, no entry shall be passed. Why? Because B is also following settlement date accounting, derecognition of financial asset and recognition of amount receivable from A. Both of these will not be recorded because B is following settlement date accounting, and therefore no entry shall be passed on 23/11/2019. When you come to 31/3/2020, that is the reporting date, fair value of the shares have changed. However, B is not a party which will be affected by the change in the fair value, because on the trade date, that is 23/11/2019, it was already understood that B will receive exactly 6,40,000 irrespective of the change in the price of the share. As a result, B is never getting affected because of the fair value fluctuation. B will not pass any accounting entry even on 31st March. On settlement date, that is 30th June, what B will do is simply receive cash of 6,40,000 and give away shares in X Limited, and the amount to be credited to shares in X Limited will be only and only the agreed value, which indicates the sale proceeds. These sale proceeds have not been decided on 30th June. These have been decided directly on 23/11/2019. Even though the recognition and derecognition did not happen on that date, the accounting and the recognition and derecognition has been postponed to the settlement date, but the substance of the arrangement remains same. After agreement between A and B for selling these shares at a price of rupees 160, any change in the price of the share in the market will not affect B, it will affect the counterparty, that is A. That is why all the fair value changes have been recognized by A only. B will not recognize those changes. I would once again recommend one thing. It is trade date accounting which is more logical, because if you would have followed trade date accounting, these shares in X Limited would have been derecognized right at the trade date, that is on 23/11/2019. So friends, write up this, and that will be end of the solution. Alright friends, you would have finished writing this whole thing. I want you to write one more note as an important note over here. When settlement date accounting is applied, an entity accounts for any change in the fair value of the asset to be received during the period between trade date and settlement date in the same way as it accounts for the acquired asset. This paragraph is meant for the party A. In other words, the change in fair value is not recognized for assets measured at amortized cost. It is recognized in profit or loss for assets classified as financial assets measured at FVTPL, and it is recognized in other comprehensive income for financial assets measured at FVTOCI. So friends, write up this important note, and that will be end of the session.